Hello, my name is Jake Saw. I'm the National Manager of the Property Club. With me today is Nicole Kelly, accounting extraordinaire. So Nicole not only does Kevin Young, so he's the founder of the Property Club, she does his tax, but also a number of our members, and she's very knowledgeable, so it's a pleasure to have you along with us today.
Thank you.
So the audience out there, the young crew, so property investing might be new to you or something you're just getting into. So I've asked Justin and Jenny Watson, your YIC presidents, who are with you today. They've sent through a couple of hard-hitting questions that I'm sure Nicole's up for. So I've got a few here that I'm going to fire at you, and we'll see how we go. All right, the first one I've got here is, what are the benefits of a tax variation? Well, first of all, start off with what is a tax variation, and what are the benefits of doing one?
Okay, well, a tax variation is basically the opportunity for you to claim what you would claim as a deduction at the end of the financial year in your weekly or monthly pay. So your take-home pay increases, and it allows you to potentially redirect that money onto any mortgages to cover any shortfalls, as opposed to getting that big refund at the end of the year. And so the advantage is obviously the immediate cash flow. Why do people do them? People do them to increase borrowing capacity because it maximises how much cash they have in their take-home pay.
And cash flow, I guess, is important, especially for the younger guys out there. So, so this is sort of based around negative gearing, isn't it? So there's another question for you. Explain to us simply what negative gearing is.
Okay, so negative gearing, in a nutshell, if you were to purchase an investment property and that property costs you $20,000 a year to maintain with interest and body corps and rates and the like, management fees, and you have a rental income of $23,000 a year. However, your depreciation schedule brings up your losses to say $30,000, then the difference is deductible against your taxable income.
And that's what Nicole's talking about with the tax variation. So the difference between the holding costs, that's the amount you can claim back. So what about, so we're talking about PAYG here, what about, there might be some tradies in the audience there, or they've got their own business. Is that something they can utilise and claim back maybe in their BAS?
No, so there's no GST on residential property.
Okay, not BAS. You better scrap that. Where was I going with that? Can't they claim it back quarterly, some of those things?
No, so if they've got PAYG income.
PAYG, yeah.
Yeah, so if they have a job and their normal tax break, say, is, at 32.5 cents in the dollar, if their negative gearing is, say, $10,000 for round numbers, that $10,000 would reduce their taxable bracket. So their take-home pay on the tax withheld would be more. Okay,
so from a PAYG perspective,
yeah,
they could maybe claim that back quarterly.
Correct, but I think where you were going with your other question, for a sole trader, so if a sole trader has income of $60,000 a year, their negative gearing will offset their taxable income as well.
Yeah.
So because that all forms part of the individual tax return.
So I guess it's not you don't really give advice what people should do, but you're an investor yourself. Do you suggest to any of your clients to do a tax variation, or wait till the end of the year to get the bulk amount? Is there a case by case sort of thing, or? It's
a preference. So some people like that big lump sum. I prefer the big lump sum, but some people prefer that additional cash flow throughout the year. It definitely helps with their planning and also with their purchasing potentially of more investment properties. So it just depends on the individual.
So I've got a few different mindsets. So I've had a few members who say to me, well, why would I lend the tax office money for a whole year interest-free where I could get that money back and offset some other debts?
Yeah.
But for myself, my partner, my wife, she's a bit of a shocker with spending money, so I prefer the lump sum as well.
Yeah.
It works better with our budgeting, so yeah, I guess it is a case-by-case sort of thing.
And it's what you do with it as well. So there's no point claiming a tax variation if the additional income is just spent. So if you're going to claim the tax variation, it's generally a great idea to redirect that back into your offset facility or some other facility which is going to accrue over the year for you.
Because at the end of the day, that extra money is actually earned by the property, I guess. It's not really extra money to go shopping with.
Yeah, although shopping's good. Yeah.
Okay, so that's a good one. All right, so what have I got here? Depreciation. So you touched on it before, but what exactly is it? How does it work?
Okay, so depreciation, there's two primary sources of depreciation with an investment property. So the building, which is generally a 2.5% depreciation rate over 40 years, and then you have plant and equipment. Depreciation is basically the useful life. So you're basically claiming or expensing a particular item at various rates, depending on what it is, over its useful life, and the useful life is declared by the ATO.
So I hope you're reading in between the lines with all this accounting jargon here, but so I guess the building component, that's normally what, 50% of the purchase price roughly? Is that sort of a rough guide for people out there?
Give or take, yeah.
Yeah, so obviously, and that's why as investors we predominantly do look at newer properties from a depreciation side of things, because as you said, over 40 years is where you claim back that money. So, and is it something like if it's pre-1985 then that doesn't apply?
For the building,
yeah,
it just depends upon the structure. I think the important part with the building depreciation is that it's unaffected by the new changes with depreciation. So plant and equipment, if it was purchased after May 2017, is no longer deductible. However, the building component remains to be deductible.
So when you talk about plant and equipment, that's basically, stuff inside the walls and the inside of the building?
Dishwashers, internal blinds,
yeah,
ovens, all the things that depreciate over a period of time. So whether that's 20% rate or a 16.66, it's all defined by the ATO.
Okay. So, so if I owned a property and I'm looking at putting in a new dishwasher or whatever it might be, that then I can claim that over 7 years or something like that?
So a dishwasher depreciates at 20%.
20%?
Mm-hmm. So that's your annual depreciation rate for a dishwasher.
Yeah.
Although if you have an investment property and you have a dishwasher generally already and you replace it, I think one of the commonly missed deductions is that you get to write off the dishwasher that you've just replaced.
Oh, right, okay. And is there, this might be going in a bit of detail, but is there a certain amount, is it $300 each or whatever you can claim back immediately rather than writing it off?
Yeah. So the threshold for an immediate deduction is $300, but if there's two people and they're 50-50, tenants in common, then that threshold is obviously $600 for the whole item, $300 each.
Okay. So another thing Nicole just touched on was tenants in common, so there's two different types of purchasing types predominantly, tenants in common or joint tenants?
Mm-hmm. Oh, well, yeah.
You're talking about joint tenants. But explain the difference between the two just quickly. So joint tenants can only be 50-50 and tenants as common is where you can apportion it, the split differently. Is that pretty much in a nutshell?
So when you buy an investment property, it goes on the percentage. So you can buy it 50-50 or you can buy it 20-80. So it just depends. But whatever that purchase rate is how you'll apply your negative gearing components.
Yep, okay.
Or positively geared.
Our cameraman here looks like he's falling asleep, so I better ask you some more interesting questions. What have we got here? There's one here which is making the most of the first homeowners grant, so that's probably almost something I can answer. Justin and Jenny might have covered it there before. So look, the benefits are obviously is getting that large lump sum. There are some rules in place, and every state's different, so if this is going to different states I won't get too specific, but generally if you buy the new property, I know in Queensland for example it's $20,000, so that can be received at settlement or shortly after, and it's very effective with getting young people into the market. I guess that's why it's there. The government have put it in place to stimulate us buying new housing and supporting infrastructure and more jobs and whatnot. Check into each state's legislation because it is different from state to state. But over here, for example, same with Sydney, Melbourne, I do know that if you were to purchase, say, an investment property first, if you then hadn't utilised or moved into that property or utilised the grant before, you're still eligible, and that's something to note as well. And it's only based on per contract, so and you can't be, I guess, together as a couple. So if I was with my partner and we both hadn't utilised it, if we were to enter in a contract together, that's only one lot of first homeowners grant, 20k. Whereas if I purchased it on my own, that's 20 for myself, and same for other partners. So that's something to remember there. But I had a lot of members over here utilise the first homeowners grant by doing that and getting a higher loan to value ratio, which the broker in the room there might cover today. enables them to get in the market a lot quicker. So it's a good little scheme. I do know in Queensland they've just dropped it from 20 to 15 as of 30th of June. So again, it changes all the time. Talk with your mentor in the room about how you can best utilise that. But yeah, that's something a lot of you won't realise is, if you've got an investment property but you've never actually moved or taken residence in that property, you're still eligible for it. So have a look into the states legislations with that.
Yeah.
All right. He's awake a little bit more than that, so I must have answered that one okay. Now, what have I got here? What else can we cover? Capital gains tax. So this is, I don't know, this is a bit of an old person's question if you ask me. It's something I haven't had to worry about too much yet, but capital gains tax, what is it? When does it apply? How can I avoid it? Well, I don't know if you can avoid it.
Yeah.
But how do you explain to us what CGT is?
Okay, so capital gains tax applies to basically any asset that you buy over $10,000, which is something that people aren't aware of. With relation to property, capital gains tax is basically the profit. So your initial purchase or your capital base or your cost base, less any selling expenses upon the sale price. So that difference is generally what's considered CGT. And if you've held the property for more than 12 months, you get a 50% CGT discount. So if your initial profit was $100,000, it would bring it down to $50,000, and then that $50,000 would be allocated to the individuals as per their ownership percentage. If that's 50-50, they would get $25,000 each, and that $25,000 basically adds on their taxable income.
So I guess from an investor standpoint, capital gains tax, I don't think it's that bad a thing because it means you've made profit on the property, which is what it's all about. Ideally, we don't sell the property, but if we do have to liquidate it, then paying a tax like that isn't the worst thing to have to do because there's some deductions and whatnot that can be made. Is there 50% discounts or something like that still in place?
So 50%. So if you hold it for 12 months, you get the 50% CGT discount for individuals. So you get that. I suppose the thing to remember with CGT is to plan for it. So potentially, if you're expecting a higher income in a particular year, you would hold off selling until a different year. CGT is calculated on contract date, not settlement date. So when you sign that contract is extraordinarily
That's important to know. Yeah, date of contract, yep.
Yeah, and if you do have a CGT that you're trying to mitigate, you can do things like prepaying expenses on other investment properties or potentially selling non-performing shares or other assets that you have a capital loss, because capital losses will offset against capital gains. So if you plan for it, it's generally not too bad.
So some of that went over my head as well, so don't worry, not alone there. It's recorded though, so maybe you can go back and listen to what Nicole's talking about, but good advice there, because there might be some renovators in the crowd too, so they might be across that they need to hold on to the well, if they're holding on for more than 12 months, then they do apply for that sort of discount, which should probably help there.
Yeah, definitely. So for people that are turning over properties a bit quicker, always a good idea.
As long as they're doing a good job and making money from it though. It's pretty competitive out there at the moment, so if it was me, I'd leave it to the experts. I've done it in the past, but I don't think I'd be game to do it now so much.
Yeah, well, I think the thing is, if you're thinking about selling an investment property or potentially just one of your investment properties, it's always a great idea to chat with your accountant first to work out which property would be the best one to sell. Yeah,
absolutely. Little plug for you as well. So Nicole is based here in Queensland, but I'm sure you deal with clients all around the country. So hopefully Justin and Jenny might have some of your details to hand out to the audience. I've got six properties. Probably not the most detailed setup you've seen, but I've got trusts and companies and all that sort of stuff. So Nicole does a great job with that. She's not too expensive either, which is nice. I've got to be extra nice to her this time of year because this is when I'm getting my tax bill and she's doing my tax, so got to butter her up a little bit. Look, one more question here. A good one to finish on maybe. So when you're, say they're new to investing or they're thinking about investing, what are some things that, potentially we don't know about that can now become deductions, maybe from everyday items, I don't know, but what then becomes tax deductible because we are property investors?
Look, I suppose where we could start with that, the biggest problem was, can we just describe that bit? Because the most commonly missed deduction for property investors is borrowing expenses. So when you go and borrow for an investment property, a lot of people end up paying lender's mortgage insurance, which can be quite significant. And there are generally a whole heap of other expenses on your loan docs, mortgage, insurance, stamp duties, banks and borrowing fees. So that all adds up, and what property investors generally miss is claiming that borrowing expense component, which, if lender's mortgage insurance is there, could be $10,000, $15,000, $20,000 to some degree. And those borrowing expenses are deductible over 5 years, broken down into days. So 1,826 days, you can claim that back, which is definitely something to consider. And if you refinance during that time, the remainder of the borrowing expenses are fully deductible.
Right.
So that's another very commonly missed deduction for property investors to be aware of.
So that's an interesting, Nicole just mentioned lender's mortgage insurance, or LMI. So what that is that's an insurance premium that anything over an 80% lend, you pay this insurance cost. So a question for you, so let's assume we're purchasing a property at 90% and there's LMI, you're saying that's deductible. What if we had another property which was leveraged off up to 90% or whatever it might be and paid an LMI premium on that as well? Is that also deductible, even if that's our own house, for then to use those funds to complete? To buy this property?
Yeah, absolutely. So when it comes to property investing, it's the nature of the borrowing and not necessarily the asset that securitizes it.
Okay.
So if I have a principal place of residency and then I take a split on that and I borrow a bit extra and I pay the lender's mortgage insurance, that split and that component of lender's mortgage insurance is deductible against the investment property that I've used it for. So
one phrase that sticks in my mind that you told me was the purpose of the loan, or the purpose of what you're spending. So yeah, that's really good information. So what about so when people are coming to you to do their tax and whatnot, and they've got an investment property, is it best if they have, say, one transaction account where that's just purely for their property costs? So is it easier for you, or is it do the ATO prefer that?
I suppose it's what's easy to administer. We're in the process of putting some software together specifically for property investors to help with managing these things. But ideally, as long as it's traceable and trackable. So as long as we can follow that flow of monies, and even the Property Club have a pretty good spreadsheet which helps investors to track what those expenses are individually and also for a portfolio. It's definitely a good way to go about it.
Okay, all right. I think we've pretty much covered all those questions. I thought we did a pretty good job. Our cameraman's still awake, so that's a bonus. So I'd like to thank Nicole for answering a few of these questions.
Thank you.
I hope you got something out of that. I certainly always learn something when I listen to Nicole. Some of it might have gone over your head, like I said, but I'm sure we can make this recording available to you. So enjoy the rest of your session. Please utilise your time with Justin and Jenny there, or any of the other presenters in the room. And it was great to have you along, Nicole. And you might be lucky enough to see her at an event live one day.
Yay!
Nicole loves public speaking, if you hadn't noticed. So she's a bit of a natural in front of the camera. So we'll try and get her along to one of those live events soon. Thanks very much, everyone. Thanks, Nicole.
Thank you. Bye.